In this recording, we're going to look at why the investment banks in the United States got into trouble during the global financial crisis. And to do that, we've got to look more closely at the securitization process, which we've got here on this slide. So I've already run through this, so just a quick review before we focus on the investment banks in terms of this securitization process. We have borrowers up here who wanted to buy a house. Now, they are comprised of both prime borrowers and subprime borrowers. They were being loaned money through either mortgage bank brokers or directly from banks. Now, particularly when the subprime mortgage boom started, and that really started because of the amount of money flowing into the United States at such low interest rates, meant that all traditional safe forms of lending had been exhausted, and the banking system then had even more money to lend, so they started looking at potential borrowers that they wouldn't have looked at in the absence of such a high degree of liquidity and low interest rates, and these were the subprime borrowers. So the subprime borrowers were loaned money. Now, these subprime borrowers are obviously very risky, and certainly the financial institutions, let's just call them the banks, would not want to keep these mortgages on their books, because there's just too much risk associated with lending money to subprime borrowers to buy a property. These subprime borrowers have an elevated a chance of defaulting on mortgage payments, and then the bank would have to go through the process of selling the house and trying to recoup their losses. So even if housing prices did increase, it still does impose costs on the bank to have to take possession of the house and sell it and try to recover their costs. There's a lot of sort of selling costs and legal costs associated with that. So typically banks want to avoid that situation. So it didn't make any sense to the banks to lend money to subprime borrowers and hold that mortgage themselves. They wanted to actually move that mortgage or sell that mortgage so that the responsibility of that mortgage was passed on to the buyer of the mortgage. And it was really the Wall Street investment banks that put their hands up and started buying these mortgages. Now, as the story goes, in this securitization process, this diagram here, the investment banks purchased those mortgages, securitized them, that is, created mortgage-backed securities, which had value because they were backed by mortgages, and the mortgages were backed by houses, and housing prices hadn't fallen in the United States in the past 50 years leading up to the GFC. So if we now focus on the investment banks, they are holding these mortgages. Now, to actually buy, the way they got into trouble goes like this. The investment banks had to borrow money to actually purchase the mortgages in the first place. They would then buy mortgages using this borrowed money and create a mortgage-backed security. They would then sell the different tranches, or the different tranches of a mortgage-backed security. As I've mentioned before, it could be a $1 billion mortgage-backed security, and there could be $1 million components to that mortgage-backed security. So they sell off the 1,000 pieces, if you like. And obviously mortgage-backed securities are more complex than that, much more complex, but I'm just keeping the story simple. So they sell off the $1 million components, and they use that $1 billion that they have received from the sale of the mortgage-backed security to repay the original loan that they undertook to purchase the mortgages in the first place. Now, obviously, they are going to make a nice tidy profit through the creation of those mortgage-backed securities, but when in the United States, it all went wrong in around sort of late 2007, early 2008. So what happened if we skip forward? I've already taken you through this diagram. These are the reset dates and reset volumes in terms of billions of dollars of subprime mortgages. So you can see here this green area, this light green area to the left, they are all of the subprime mortgages, the interest rates on those subprime mortgages resetting up to the higher level. Now remember, with these subprime mortgages, they were offering very low teaser rates initially on these subprime mortgages. Then, after 2 or 3 years, the interest rate would reset to a higher level. And the thinking was that at that point, the homeowners would then have equity in their home because they may have paid off some of the principal, and housing prices were expected to increase over this period, so they would have some equity in their home now. They would then be perceived as being less risky because they held some equity. They would be able to go to their financial institution and negotiate a better deal. So the thinking was they wouldn't have to pay those higher reset rates. But housing prices over this period, 2005, 6, 7, really did flatline in the United States. So they didn't increase, partly due to the building boom that occurred. There were so many new houses being built during this period that supply increased substantially, and that just kept prices flat. So when these interest rates started to reset in 2007, 2008, homeowners, subprime homeowners, didn't have equity in their own home. They couldn't negotiate a better deal, so they were left with no option but to repay the higher interest rate. Well, of course, a lot of these people couldn't afford to repay the higher interest rate, so in states which had non-recourse loans, they simply walked away from the home, and in the states that had recourse loans, a lot of these people just left their home and declared bankruptcy. So that really started a wave of defaults, mortgage payment defaults across the United States. Banks started repossessing houses, selling those houses, and then the number of people who started defaulting started to accelerate when prices started to fall. So housing prices started to fall. Now this makes it very interesting for the mortgage-backed security market, because mortgage-backed securities are backed by mortgages, and mortgages are backed by houses. But when you have a wave of defaults on mortgage payments, which then force housing prices down, then you've got a problem, because the mortgages which are backing the mortgage-backed securities, those mortgages are effectively dropping in value because the housing prices that are backing them are dropping in value. And so there was a lot of confusion because people really then didn't understand the implications for the mortgage-backed security market, and there was a little bit of a panic there. So with these mortgage-backed securities, as I've said, they're backed by mortgages, and the mortgages are backed by bricks and mortar. The prices of bricks and mortar start to fall, then there's a big question mark over the mortgages. You know, what are they really worth? And if people then start asking, well, what are these mortgages really worth, because housing prices are declining, then the next question is, well, what's really backing these mortgage-backed securities? Mortgages which are effectively declining in value. So no one wanted to buy these mortgage-backed securities anymore. And so Wall Street got into trouble for the following reason. They had borrowed money to buy mortgages. They were in the middle of creating the latest lot of mortgage-backed securities, but then housing prices started to fall. And the investment banks were in the situation where they had borrowed money to create mortgage-backed securities, but housing prices started to fall, so they couldn't sell the mortgage-backed securities. That meant they couldn't recuperate, they couldn't sell the mortgage-backed securities, they couldn't get that $1 billion of revenue from the sale of mortgage-backed securities, and therefore they couldn't afford to pay the original loans back that they used to purchase the mortgages in the first place. So they were stuck. And of course, when housing prices started to fall and mortgage-backed security markets froze, in the sense that no one was buying mortgage-backed securities at the onset of the GFC, then the organisations that had made these loans to the investment banks in the United States originally, they started calling up the investment banks wanting their money back. And of course the investment banks couldn't give them their money back because they couldn't sell the mortgage-backed securities. So the investment banks were stuck. Now, what then happened was the Federal Reserve and the US Treasury and a couple of other agencies in the United States got together and they basically bailed out the banks. So this process is quite complex. The bailout process is quite complex, and I encourage you to do some reading about that if you're interested. It's really, the bailout process is beyond the scope of this course, to be honest, but it is a very interesting area, and you can do some reading in your own time if you like. But basically, it involved, or the big part of it was provision of liquidity, provision of money to the investment banks, sort of lending windows were created so that the investment banks could borrow money to repay the loans and start operating again. So there was that. And the other part of it was eventually the Federal Reserve purchasing mortgage-backed securities out of the, or from the banking industry in the United States to clear all of these toxic assets out of the system. And so even today the Federal Reserve, I think the latest figure is they're holding about $1.7 trillion of mortgage-backed securities. Okay. So that's how the investment banks got into trouble. The only other thing that I wanted to do was talk about the aggregate demand, aggregate supply model. Now I'm going to leave it to you to read up on how to use that model, or how to use it to model or illustrate shocks to the economy, shocks that affect the aggregate demand curve, the aggregate supply curve, and policy responses that can be used to try to shift the economy back to full employment. Now, the policy responses that we'll be going through are basically fiscal policy on the right here, and we're doing that in a couple of weeks' time. And very soon we are looking at monetary policy. And when we look at monetary policy, we'll be looking at traditional monetary policy and non or unconventional monetary policy, which is quantitative easing and negative interest rate policy as well. Another non-traditional or unconventional monetary policy we'll be looking at is forward guidance of interest rates. So the whole idea of this topic was to look at the global financial crisis, learn a little bit about what went wrong, encourage you to do some reading in this area, and then get you to start thinking about how the aggregate demand and aggregate supply model could be used to model A, the effects on the economy of a big economic shock such as the global financial crisis, and B, policy responses that can be implemented to try to get the economy back to full employment. So I'll leave it there.